Hey guys, Toby Mathis here, and today we're going to talk about how to avoid the 2026 tax hit because there's this new $40,000 SALT loophole. There's senior tax breaks. They've done upgrades to the health savings accounts and a bunch more. So if you own a home, a business, if you give to charity or you're age 65 or older, or even if you use an HSA, 2026 can quietly change your tax bill by thousands of dollars. One wrong move, however, with timing, and it could jam money into the IRS tip jar for absolutely no good reason. All right, so let's jump in. The new federal law, the one big beautiful bill, landed right flat in the middle of 2025, right? The big changes have hit in either late 2025 or throughout 2026. So today I'm going to break down many of the biggest changes and I'm going to put them into plain English. So here's what I'm going to cover. Number one, right? The bigger senior standard deduction and the income phase outs that you have to avoid. The SALT cap jumping to $40,000 and who loses it, how to lose it. The charitable rules that are changing in 2026. Yep. And there's some easy timing wins that I'm going to go over. HSA upgrades allowing for direct primary care and telehealth, and a bunch of other the pro stuff, the people that are on YouTube that you're going to hear experts talk about, including individual tax rates not jumping up, right? The QBI being made permanent, that's that qualified business income 20% deduction, the 100% bonus depreciation being restored. I've done some videos on that. And the $15 million, if you're single, or $30 million estate tax exemptions starting in 2026. And that's kind of just to name a few. So let's jump into the changes that have the biggest impact on the largest number of people. All right, so number one, let's talk about our seniors. If you're 65 and over, or you know somebody who is, so pay attention to this, because starting in 2025, each taxpayer who's over 65 years of age, 65 plus, gets an extra $6,000 on top of the usual senior bump and standard deduction. Yep, this is even if you do not itemize, you're not doing Schedule A, you still get to use the $6,000 per person deduction in English. This, whether you itemize or not, if you're married, you get an extra $12,000 a year deduction, even if you do not use the standard deduction. But if you do use the standard deduction, it's going to look like this. About 90% of you guys use the standard deduction, so make it easy, right? So if you're single, you're 65 plus, start with the $16,100 standard deduction plus a bump, because of your age, of $2,050 plus another bump of $6,000, which means if you're doing math, it's $24,150. If you're married and you're both 65 plus, so remember this is the $6,000 bump is per taxpayer who is 65 years or above. You start with the $32,200 standard deduction. You get an extra bump of $1,650 per person. That's for a married couple. I know it's less than the $2,050 for a single, but that's just the rule. Plus, you get an extra $6,000 per person. So if both married spouses file jointly, in other words, guys are married filing jointly, you're both 65 and older, it would be, get this, $47,500 tax-free. So if you're a married couple, let's say you make $150,000 per year, then boom, you knock $47,500 off that amount. You're just over 100 grand. All right, so you might be asking, what's the catch? Yep, there are some income phase outs on the $6,000 per person. Your senior bonus shrinks as your adjusted gross income, which is actually MAGI, I think it's a modified adjusted gross income, rises. So for married people, you start to phase out at $150,000 and it is gone by $250,000. If you're single, it starts to phase out at $75,000 and it's gone by $175,000. So knowing that, if you're close, like you're right around there, what moves could you potentially make that would push you over the line where you would lose your deduction? Well, let's talk about this, because there's a few you should be cautious about, because there's all these people on TikTok, Instagram, YouTube, they're always telling you to do crazy stuff. The number one thing I see is if you're doing a big Roth conversion, all these guys, oh, convert your Roth. I'm not convinced of the math. It usually takes 30 years for you to recover. But a big Roth conversion, a large IRA or 401k withdrawal, just taking it out and having it taxable, having large capital gains, like whether you're selling a bunch of stocks or property sales, maybe you dumped a couple of years of real estate. You know, I wouldn't bring those up if there weren't some easy fixes, by the way. Like, those are the things that can push you up. So here's a few solutions to those situations. Number one, if you're convinced you really want to do Roth conversion, you're just chomping at the bit, do the math and maybe spread it out over 2 or 3 years. You don't have to do a big conversion in 1 year. You can actually do partial conversions over many years. And you would just say, hey, I want to push up against the limit, but I don't want to lose my $6,000 deduction, right? How about don't stack a big Roth conversion and a big IRA or 401k withdrawal into the same year? Maybe, like, I don't care whether it's big stock sales or selling things out, spread them out over multiple years so that you don't lose a deduction. If you spread it, and I'll go over some examples at the end, you could avoid losing your this bump and this extra $6,000. You want to make sure that you get it. So the bottom line is to keep your income under the phase-out band if you can. And you don't want one big money move to wipe out your senior bonus. All right, number two. This is number 2 on our list. This is really for homeowners and folks in high tax states, right? The SALT deduction. It jumps to $40,000, but not for everyone. From 2025 through 2029, the SALT cap, which is state and local income taxes, including property taxes, it rises to $40,000 for itemizers only. If you take the standard deduction, this is not for you. If you're in a high tax state and already itemized, this can finally count more of what you pay. Like, you're going to get a bigger deduction. But there is a gotcha. And it's in the form of a phase out again. So there's a phase out for higher incomes. So the SALT benefit starts to phase out at $500,000 of modified adjusted gross income and are fully gone by $600,000 of modified adjusted gross income. So one-time events, again, can blow this up for a single year by pushing you into the higher brackets. So what you have to watch out for is like a business sale, large stock sale, mega Roth conversions, or any large IRA distributions. So smart timing is required if you're near that $500,000 to $600,000 modified adjusted gross income. If that's you, you should be looking at splitting income evenly across 2 years. Even if you did like a December and January split, as long as it passes over a calendar year end, you're good. So long as the income is received in 2 different tax years. So you could convert a Roth on December 20th and on January 3rd do more, and they're in 2 different tax years to keep from pushing over your modified adjusted gross income limits. Line up property tax payments and state estimates to fit more under the $40,000 cap in the years that you benefit. So for example, if you know this year I'm going to take the SALT deduction, then I have up to 40 and maybe I'm at 25 or something, pay property taxes a little early, but only, this is a big one, only if they've been assessed, right? You can't pay early on non-assessed property taxes. It has to be assessed. So if your county has assessed the taxes and you would be paying early the following year anyway, it would be wise to pay them a couple of months early and put it into that particular year. Maybe you could pay your state income tax early. Again, only if it's assessed. And just think about this, you can definitely pay your 4th quarter taxes early. Like, we could do that for absolutely for sure. Otherwise, if you have taxes that you know you're going to be paying into the state, maybe pay them right before the end of the year. How about this? harvest gains earlier if you think you'd be selling them the following year as well. For example, if you have a stock that has a $100,000 gain, maybe sell it now and pay the tax because you can deduct the state tax this year, right? I probably just broke some of your brains. When you sell stock, you sell things, the state tax, boom, gets due. So I could sell it, incur the state tax that I know I'd be incurred anyway. Now this is going to trip you out, and then you buy it right back. And you're going to say, but what about the wash sale rule? The wash sale loss rule is only for losses. So if you have gains and you know you're going to sell it, you can just step up your basis, you sell it, you buy it right back. And now I've incurred the state tax and I can deduct it. Whereas possibly the next year I wouldn't get to deduct it, right? So if you know, hey, I am definitely not, I'm going to be itemizing and I'm not using my full 40,000, maybe this is a time for you to say, hey, let me get some more of that 40,000. Property taxes, state income taxes, if I can get them assessed in the year now, like I'm in 2025, if I could do it before the end of the year, then yes, then I can write it off towards my 40,000. Let's go over some other examples. Maybe I need, hey, I'm going to have the state tax and I want to have more income. Maybe I opt out of an installment method. Maybe I've done installment sales, things like that. Maybe issuing bonuses that are normally paid in the first quarter, see if you can get them paid in the fourth quarter. Hey, I know that we're getting paid in January. Any way to get that now? Because I can write off the state taxes. Maybe this is where you do convert to convert a Roth, convert a traditional IRA into a Roth IRA, or maybe you opt out of a deferred compensation plan. There's just a few, and if you're and if you'll be over $600,000 anyway, then don't try to do crazy contortions in your life for SALT. Focus on other levers, like maybe I'm doing some charitable giving and I'm doing some bunching before the end of the year, so charitable timing. Maybe I'm doing retirement distributions planning where I'm sending that straight to a charity. Or if you have a business that flows through, this is a huge one. I want you guys to listen to me very carefully. If you have a flow through business, pay the state taxes at the entity level and deduct it there. You can deduct it an unlimited amount of pass-through entities. It does not matter what your personal income is. That will work. You get to write off the state and local taxes if it's through a pass-through entity. So if you have the S Corp, partnerships, and it can pay the tax, and you would be pushing yourself to where you're going to phase out of the 40,000, it's going to push it down to 10. You want to keep yourself up there. Maybe you say, hey, I'm going to phase out anyway. I'm going to pay it through the entity, and it's going to deduct the state and local taxes. No limit. All right, number 3, let's move on to charitable giving, because this one gets a big makeover in 2026. So if you don't itemize, then starting in 2026, you can deduct cash gifts up to $1,000 if you're single or $2,000 if you're married filing jointly. And this is to operating charities, 501c3s. This does not include donor advised funds. It has to be an operating charity or private foundations. It has to be a public charity, even if it's one you formed. So here's a simple win. If you give monthly and don't itemize, shift late 2025 gifts into early 2026 to capture the $1,000, $2,000 benefit, right? If you do itemize, then in 2026, there's a 0.5% AGI floor. So you lose the deduction up to that amount. So again, if it's 0.5%. So it seems innocuous, but let's say you're making adjusted gross income of $50,000 or something. So $250 you don't get to, you're going to lose, and then you're going to get it. And then only giving above that counts. And by the way, if you have excess, you can always carry forward 5 years the excess gifting. Plus, if you're in the top bracket, the value of your deduction is now capped at 35%. So if you know what the top bracket is, it is 37%. So if you're somebody who's in the 37% tax bracket and you're giving money in 2026 and beyond away, it's only going to be deductible to the benefit of 35% of that. So say what, right? So let's say you're donating $10,000 in 2026. the first $50 is not counted at all. And if you're in the top bracket, well, it just means your donation is maxed out as being worth 35% of that $10,000. So you get a deduction of $3,500 instead of $3,700. I shouldn't say deduction, but the tax benefit is going to be $3,500 of tax that you would have been paying instead of $3,700. But what if you're doing a large gift? I would say really consider giving it and finishing it in 2025 before the new floor and the cap comes in and causes you to lose a little bit of that benefit. And then use donor advised funds to bunch your deductions of multiple years, and giving them, do it in 2025. And then you could issue the money from the donor advised fund. If you don't know what this is, it means it's basically, I could go to any brokerage firm and open up a donor advised fund, and I put money in it and it can grow. I could trade it and do everything, and I just have to give it to qualified charities that particular brokerage house allows you to contribute to. We have one here at Anderson too for the people that set up charities, public charities through us, and they can give to their own charities, but you do it in the future. So let's say that here's in other words, I'm going to say you could give appreciated assets like stock or crypto, things that have jumped up, and maybe even real estate. And for those appreciated assets like stock, crypto, real estate for held that are greater than a year, then gifting avoids you having to sell it and recognize capital gains, but the deduction is the fair market value. And so you pair this with the bunching. So for example, if I give you $10,000 of cash, I get a $10,000 deduction. But if I give you $10,000 worth of stock, I only paid $5,000 for. Well, I still get a $10,000 deduction. I just paid a lot less for it. And so if you bunch and you do that into it like a donor advised fund, you could be spreading out, hey, I'd be giving, let's just say you're somebody who gives $10,000 a year, maybe you're tithing. So do $30,000 of value in 2025 and then use that $30,000 to make gifts in the following 3 years, future years. Or maybe you do, hey, I did my $10,000 plus I did $30,000 into the donor advised fund. I had $40,000 of deduction in 2025, and then I give $10,000 next year, to the $10,000 the following year, $10,000 the following year, out of the donor advised fund. There's no floor, there's no limits, there's no nothing. I've already gotten the deduction in 2025. I front loaded it. All right, on to number 4. And this one impacts everybody, right? It's the health savings account upgrade. HSAs are the triple threat, right? You get a tax deduction no matter what you make. You just have to meet the eligibility by having a high deductible health insurance plan. And by the way, you do not have to pay tax on the growth inside the HSA. So when we say triple threat, you get a deduction, you don't pay tax on the growth, and then when you take it out, so long as it's used for health, dental, or vision, you pay 0 in tax. So let's just say in English, in 2026, you can deduct up to $4,400 individually or $8,750 for a family. Oh, if you're over 55, add another $1,000 to those, so long as you have a high deductible health plan. For example, in 2026, if you have a family plan, the deductible must be $3,400 per year with a max out-of-pocket of $17,500. The easiest thing I could tell you is check with your plan administrator. I'll just say that most plans qualify. And there are some things that will automatically kick you out. So if you're dependent, you can't do it. If you have a PPO, you can't do it. If you or a spouse, or if you're on Medicare, done. But these are beasts. Like these health savings accounts are absolute tax monsters if you're eligible. And I'll give you an example. I put money into mine every year, but for a few years, the market just jumped. It tripled. And the market, I didn't pay any tax on that. And as long as I use it to reimburse myself for any medical expenses that have come out of my pocket since I set the plan up, guys. I sent this up years ago and I just track my co-pays and my deductibles and things like that. I can reimburse myself. All of that, but I could wait 20 years to do it. I don't have to reimburse as I go. Some people do, but you can just let that thing grow and grow and grow. And especially as we get older, we're going to have health expenses. So this is a great place to have it. It just keeps growing and growing, and then I take it out. And then you're like, well, but what if I don't use it? Well, then if you're over 65, you could take the money out. You pay tax on it when you take it out, but it's kind of like an IRA. I got a deduction, and then I have to pay tax when I take it out, but you don't have minimum distributions out of these. They're just, trust me, these things are beasts. And then starting in 2026, get this, you can use $150 a month from your HSA, this is for a single person, $300 if you're married, to pay for direct primary care or concierge fees, tax-free. So you're thinking, well, I never get to write off any of my medical expenses. I use a concierge. Well, maybe you should put money in an HSA and start paying it through that, because now at least I get a deduction. I get a deduction when I put it in the HSA, and I don't have to pay tax when I take it out. Now, the cool changes. You can join a direct primary care, a DPC membership, and still contribute to that health savings account so long as you are covered by a qualifying high deductible health plan. And telehealth can also be covered before the deductible without breaking the HSA eligibility. So do this, right? Confirm that your health insurance plan is HSA eligible for 2026, and then increase your HSA contributions if your budget allows it. You get a deduction for whatever you put in there up to the limits. And if you like concierge services or direct access, consider using the $150 monthly allowance, $300 if you're married, to fund it. And you get a deduction, and you're not using tax, like your after-tax dollars. You get to write it off. This is the first time that a lot of you guys have ever gotten to write your health off. This is how you do it. Do the HSA and pay it. Now here's some other tax pro stuff you hear other CPAs and advisors talking about, and I'll explain kind of why it matters. The individual rates and the brackets are staying friendly. There's no big rate snapback that was supposed to happen if they had not passed the One Big Beautiful Bill. The Tax Cut and Jobs Act brackets were going to go back to the higher rates. Everybody was going to get moved up. The highest tax bracket, for example, was going to go from 37 to 39.6, what it was, but that is not happening, which keeps planning stable for everybody. Retirees living off of their portfolios and business owners, for example. This stuff really matters, right? It's still smart to protect your bracket before you stack income into a single year. You got to look at that. The other thing is qualified business income. It's 199A. It's this 20% thing, right? It's permanent. It's permanent now. So pass-through owners get to keep the 20% qualified business income deduction beyond 2026, right? With a minimum benefit for modest active income. So revisit things like your reasonable compensation for S-corps and W-2 leavers to make sure that you are getting that 20%. There are some phase-outs depending on how much money you make for different types of businesses. And some of it, the higher you get, they start doing a ratio of how much W-2 income and other assets you have as to whether a portion of it is still eligible to get that 20% deduction. So you want to make sure that you're meeting with an accountant, especially towards year end, to do your calculation to make sure you don't inadvertently phase out of that 20% deduction. Here's another huge one, and everybody, including me, has been talking about it. It is the 100% bonus depreciation has also been restored and is permanent for eligible assets. So this is great for equipment, furnishings, leasehold improvements. And by the way, if you pair this with a cost segregation, like this can actually just go crazy. So keep your engineering work papers, your photos, support documents, just so you could survive an audit if you decide to take the cost segregation, or easier, use a cost segregation company and they do an actual report. And then you could decide, do I want to bonus a big chunk of that and take a big deduction, or do I want to just let it spread out over the 5, 7, 15 year, whatever those assets are. But if it's anything under 20 years, you could write it off 100% this year if you bought and put in the service in 2025, 2026, 2027. Like, you're going to get the 100% bonus depreciation. Now let's talk about the estate tax, gift tax, generation skipping tax. Everything's gone to $15 million per person, and it's indexed from 2026. So that's basically in 2026, it's $30 million for married couples. You still need to make sure that you're handling portability. A lot of people just say like, oh, I don't have to worry about it anymore. You still got to think about making sure that if one spouse passes, you're using their $15 million and you keep their $20 million. Usually you're electing portability. You also have to be cognizant that there are when I say state, like Washington State, estate inheritance thresholds. So your state may tax things much earlier. Like Oregon, I think, has $1 million. Right? That's the only exclusion. So you're thinking, oh, I'm underneath 30 million or I'm underneath 15 million, I don't have to pay any tax, and then you get a surprise that your state is hitting you. Also look at inheritance thresholds for existing things like SLATs, ILITs, family limited partnerships that were created for purposes of keeping you below certain numbers. Just take a look at that. Like, it might be that you don't need to go through all that complexity. And if I was going to put this into English, I would say here's your translation, right? You might have more headroom than you thought. So update your documents so they match what the actual numbers are and your actual goals. Now, things to watch out for in 2026, right? These are the big ones, right? I've already covered some of these, but I'm going to repeat them so that it's etched into your brain. If you are doing a Roth conversion, if you're doing large IRA withdrawals that aren't going into the charities and things like that, if you have large capital gains, then you need to be cognizant that you might lose your senior bonus or STALT benefits for that year. So you want to be looking at whether I could spread it out. Making 2026 gifts the same old way you always have, you might find a little bit like, oops, I didn't realize there was a floor, I didn't realize there was a cap. Taking bonus depreciation cost seg without doing some sort of report, it's a great deduction, but you're going to have a headache if you don't back it up. So I'm always going to say, if you're doing real estate, get a cost seg plan, please. We have great referrals we can give you that we could send you over. Watch some of my videos on cost segs. I've done so many of them where I always bring in experts that do this stuff day in and day out. That's who you want to use. Don't want to use your accountant. You want to use somebody who specializes in doing those types of reports. It's going to save you a world of headaches later if it's such a great benefit and if it ever gets looked at. Now, by the way, they're not triggering audits. We work with one company that's done over 20,000 cost seg reports, and they have a handful of audits total. It's a very small amount, but if you don't have your backup and if you don't have your numbers, you're going to lose that deduction. Now let's do a couple of examples of problems that could occur but that have easy fixes. So let's assume that John and Sally are married retirees. They're both 67 and they want to convert a $200,000 Roth in 2026 because they're talking to somebody who keeps telling them, do a Roth conversion, do a Roth. Ugh. That pushes them into the senior bonus phase out and could cost them an extra $12,000 deduction. The fix, you guys already know it, is you convert $100,000 in 2026 and $100,000 in 2027. I don't care if it's on December 31st and January 1st, right? You're spreading it over 2 tax years. And they get to keep the senior bonus both years and still move that money to a Roth at today's rates. And especially if you think we're going to have a melt up, I kind of do, then those Roths are particularly enticing because now you're saying, I paid the tax, I'll never pay tax again. I get it. I still scratch my head. I want to do the numbers. I want to run it. But anyway, we can keep you from getting the phase out. Now let's go over another one. Let's say Mary. Mary is a California homeowner and she has a big state and local taxes because she's got expensive property. She itemizes with $32,000 of property and state income tax. She is under the $40,000 cap, which, by the way, is going to be from 2025 to 2029. It's not permanent, and this finally counts. She plans to do a stock sale, though, late in 2026 that would spike her income over $600,000 and wipe the salt away for that year. So what is the fix? You already know it, right? You guys are following along. You're getting it. You sell half in December of 2026, half in January of 2027, and she would preserve the SALT for, she would, for definitely for 2026, she gets it, 2027 probably too, right? Now let's go over, let's call them Pam and Sam, right? And they're a charitable couple. They love giving money away, and they give $15,000 a year. In 2025, what they do is they gift appreciated stock into a donor-advised fund equal to 3 years of giving, so $45,000. They lock in a big deduction before the 2026 floor and cap, and then grant out their normal monthly schedule from 2026 to 2028. And it works out great. They're just donating out of the donor-advised fund as opposed to their individual name, but they take the deduction now. Now let's go over and we'll talk about Troy and his health savings account. Plus, he has direct primary care. He likes same-day doctor access, right? He's a medical snob. He wants to make sure that that doctor answers his phone and he doesn't have to wait in the waiting room with everybody else, right? But he wants to keep his HSA status. So for 2026, he confirms that he has a high deductible health plan, and then he enrolls in the DPC and uses $150 a month from the HSA to fund it. And by the way, his routine telehealth stays pre-deductible. That's great, right? You don't have to, you can immediately pay that back, or you can reimburse yourself. See if I can find my words. You can immediately reimburse yourself. All right, so the 2026 changes reward timing, right? So you keep your senior bonus by smoothing income out over multiple years. You use the $40,000 SALT cap in the years that you will benefit. You could say, this is the year I'm going to do it, not next year. I'm going to try to cram everything in here. You can time your charitable gifts around the new floor and the cap, and you can let your HSA work harder because you can now use it for things you used to not be able to, so telehealth and direct primary care. And if you own a business or a property, you can lock in wins from the qualified business income, that 20% deduction, plus you have that 100% bonus depreciation. And all of this without creating audit headaches, right? So make a small plan now so April does not surprise you. By the way, I just threw a lot at you, so throw your comments below. And if you can, like and subscribe. It helps the channel. And if you like tax tips from a tax attorney, and this tax attorney, make sure you subscribe. And I'm going to link another great video that has over $3 million views, all about staying invisible to lawyers, snoops, and ex-wives, and anyone else you don't want knowing what you have. I'll put that in there next. See you guys.